The European rates trade just snapped, and 8% on the 10-year Bund is the kind of math level that turns a normal move into a forced unwind. Not because the number is magical on its own, but because there's a machine behind that number. Clearinghouses, collateral desks, hedge books, and leverage. That doesn't care about anyone's narrative. And right now, that machine is leaning on one side of the boat while a chorus of comfortable voices tries to tell you it is nothing but data. But the next detail is what flips the whole setup. The Bund isn't just a bond. It's Europe's collateral heartbeat. When that heartbeat changes rhythm, markets don't gently adjust. They lurch. And by the time the headlines catch up, the positioning damage is already done. Stay with me because I am going to give you the clean roadmap for the next 1 to 2 weeks. Which level matters, what confirms the squeeze, what breaks the thesis, and the exact signals to watch when the screen is trying to hypnotize you with noise. First, let's call the move what it is. When people say it collapsed, they're talking about price, not yield. Yields moving down toward the high twos means Bund prices moving up fast. That's the part that matters. Price up means someone who was short duration just got run over. Price up means a hedger who thought they had time suddenly has a deadline. Price up means your collateral value changes, your funding cost shifts, and your risk models demand action. That's where the real pressure starts. Zoom out for a second. The 10-year Bund living around this high twos area is not a random place on the chart. Hit as a zone where the market has been negotiating two stories at once. The inflation is coming down, so rates should be lower story, and the fiscal supply and term premium have to be paid story. When those two stories argue, you get chop, you get range, you get everyone confident they can fade the edges. And then one day, the range stops being a range. It becomes a trap. Because if a crowded position is leaning the wrong way, the chart doesn't need a massive catalyst. It just needs a catalyst that arrives when liquidity is thin and risk budgets are tight. And that is exactly how these trades break, not with a bang. With a sudden lack of bids or offers right when everyone needs them. Because if this one level breaks, the math changes. Now, the mainstream explanation will want to put everything into a single box. One print, one speech, one headline. Inflation softened. Growth is weak. The ECB is on hold. Pick your flavor. Here's the problem. Even if those statements are broadly true, they don't explain the speed, they don't explain the shape, they don't explain why the move feels like a margin call instead of a reassessment. And when the shape of a move doesn't match the story, you should assume the story is incomplete. But that's not the part that matters. The part that matters is what the story is hiding, positioning and plumbing. Let me give you the hidden detail in plain language. In Europe, the Bund is not just the German 10-year. The Bund is premium collateral. It's the thing repo desks love. It's the thing balance sheets trust when they're trying to minimize headaches. It's the thing that gets posted, rehypothecated, netted, and used to make other trades possible. So when Bund prices jump, the impact is not limited to bond investors made money. The impact is that the collateral ecosystem shifts. Funding becomes easier for some players and more stressful for others. Relative value trades suddenly change their attractiveness. And the spread between a government bond and the interest rate swap curve can start telling you more truth than the yield itself. The price can look calm while the plumbing is screaming. The spread is the confession. And once you see it, you can't unsee it. Here's how a Bund move becomes a European margin call without any cartoon villain pushing a button. Imagine a fund that has been running a classic macro trade. Short duration in Europe, maybe through Bund futures, maybe through swaps, maybe through a basket that expresses rates stay higher for longer, or fiscal supply pushes yields up. That trade doesn't have to be insane. It just has to be leveraged enough to make the carry attractive. Now, Bund prices rise, futures move, swap rates move, the fund's P&L goes negative. But it's not just a mark on a spreadsheet. If the position is cleared, the clearinghouse demands variation margin. That's cash due now, not tomorrow, not after we write a letter, now. And when volatility spikes, margin requirements can rise too. So the fund might face a double hit, losses plus higher margin. That's when thesis stops mattering, liquidity matters, cash matters, because the clearinghouse does not accept your macro view as payment. And that's where the real pressure starts. The first forced action is usually not a dramatic liquidation, it's trimming. It's reducing risk to get margin under control. But trimming a crowded trade can move the market. And once the market moves, it triggers the next player's risk limits. And that triggers the next. This is how you get reflexivity. Price movement forces behavior that creates more price movement. Not because everyone suddenly believes the same story, but because everyone is forced to do the same thing. Cover, hedge, cut. That's the loop. And who gets forced first? Not the retail investor, not the pension that holds bonds unlevered. It's the sophisticated book that is levered enough to care about small moves. It's the relative value desk that thought the basis would behave. It's the macro fund that thought liquidity would be there. It's the bank's hedging book that can't exceed VAR. It's the systematic strategy that reduces exposure when volatility rises. It's the risk parity allocation that cuts duration when correlations flip. And the order matters, because it tells you how the move can continue even after the news is old. The news is a spark, the positioning is the fuel, and the clearing process is the wind. Now let's talk about why 2. 8% feels like a line in the sand. In markets, levels matter when this change behavior, not because they're aesthetically pleasing. Around 2, 8% is a place where a lot of participants who had been living with a higher yield regime start feeling the shift in regime under their feet. It's a place where chart-based traders see a break and momentum strategies wake up. It has a place where hedgers who waited for a better entry realize they are about to miss the move and they rush. It's a place where option dealers who sold volatility have to start managing gamma more aggressively. And when gamma dynamics get involved, you can go from a grind to a snap. Let me make gamma and hedging intuitive without turning this into a lecture. Options create a situation where the seller of the option has to hedge their exposure as the underlying moves. If dealers are short options and the market moves through key strikes, they may need to buy or sell the underlying to stay hedged. In bond futures, that can mean buying futures as prices rise or selling as prices fall, depending on whether they're long or short gamma. The important point is not the algebra. The important point is that certain levels can trigger mechanical flows that amplify the move. That's why you'll sometimes see yields slide with a smooth, relentless feel, even when headlines are quiet. It's not emotion, it's math. But that's not the part that matters. The part that matters is when those flows collide with thin liquidity. And liquidity is thinner than people admit when everyone is on the same side. You can have a or-deep market on paper and still have a shallow market at the moment you need it. Because depth is not a static feature, it's a decision. Market makers provide liquidity when they are paid enough for risk and when their balance sheet allows it. When volatility rises, the price of liquidity rises. When dealer balance sheets are constrained, liquidity thins. When a move is one way and fast, people pull quotes. Not out of malice, out of survival. And when quotes pull, the next trade prints at worse levels. That worsens P&L, that triggers more forced behavior, and that's where the real pressure starts. Now let's stack proof, because one argument is never enough in this game. First layer, policy posture. When central banks signal we are comfortable where we are or we can hold, it freezes one part of the curve. The front end becomes less volatile because the path of policy rates is less debated in the immediate term. That doesn't reduce overall risk, it shifts it. It pushes the fight out the curve into the long end where term premium and growth expectations wrestle. So you can get a situation where the market isn't panicking about next month's S-rate decision, but the 10-year is moving because the market is repricing the long-run balance of inflation, growth, and risk premium. That's your macro layer. Second layer, fiscal supply and issuance rhythm. Germany and Europe more broadly have real supply to fund. Bonds have to be issued, auctions have to clear, dealers have to intermediate. The market has to decide what yield level compensates for holding duration risk. Here's the twist. Supply can be bearish for prices over time, but in the short run, the supply calendar can intensify hedging flows and make squeezes more violent. Because dealers often hedge inventory with futures and swaps. When auctions approach, hedging demand changes. When auctions pass, hedges unwind. And around those windows, prices can move in ways that look irrational if you're only watching inflation headlines. The calendar is a catalyst. That's not the part that matters. The part that matters is what the calendar forces participants to do. Third layer, periphery spreads. In a classic European stress event, you would expect Italy and other higher spread sovereigns to widen sharply versus Germany. You'd see the BTP Bund spread blowout. You'd feel credit fear. If spreads are not screaming while Bund yields slide, that's a clue. It suggests this move is not primarily about euro breakup risk. It's more consistent with a core duration repricing, a flight to liquidity and collateral, and a positioning unwind. In other words, it looks less like a credit crisis and more like a rates machine resetting. That distinction matters because it changes what you watch next. If periphery spreads start widening hard, that's a different regime. That's a different movie. But if they don't, then the move is likely being driven by core collateral preference and rate path repricing. Fourth layer, foreign exchange behavior. In true systemic European stress, the euro often behaves differently. More panic, more disorder, more one-way flows. If the euro is not collapsing, that's a second cross-check. It suggests the market is not pricing an existential event. It's pricing a shift in rate differentials, in growth expectations, in the relative appeal of holding euros versus dollars, and in capital flows. FX is not a perfect thermometer, but it is a useful witness. It tells you whether the move is a localized rates repricing or part of a broader stress pattern. And right now, the more consistent read is repricing rather than collapse. Fifth layer, global rates echo, and yes, Japan matters. When Japanese yields rise and the Bank of Japan moves away from ultra-loose policy, the global cost of duration changes. Japanese investors have been a structural buyer of foreign bonds for years, and hedging costs matter. When those hedging costs shift, cross-border flows can shift. And when the global pool of safe yield reallocates, it doesn't do it politely. It does it through big, price-insensitive flows. Europe is not isolated. Bunds are part of the global duration complex. If Japan is repricing its own curve, if the US curve is moving, Europe can get dragged in both directions. The point isn't to blame Japan for everything. The point is to respect the global arbitrage pressure. Because if this one level breaks, the math changes across markets. Now, I want to bring you back to the hidden detail again, collateral and spreads. If you want the truth of this move, don't stare at the yield alone. Watch the plumbing. Watch bond futures behavior relative to swaps. Watch swap spreads, asset swap spreads, and the way the market prices government risk-free versus bank credit in swaps. These relationships can tighten or widen depending on funding stress, collateral demand, and regulatory balance sheet constraints. When collateral is in demand, government bonds can richen relative to swaps. When balance sheets are constrained, spreads can behave in ways that surprise people who only trade direction. This is where professionals look when they trying to answer one question. Is this move driven by fundamental repricing or by a temporary squeeze in funding and collateral? And that's where the real pressure starts. So what does 8% specifically do to the ecosystem? It threatens a whole lineup of short duration expressions that were built on a higher yield assumption. It pulls forward hedging demand from real money that was waiting for better yields. It changes the carry dynamics in futures. It changes convexity hedging for structured products. It changes what bank treasury desks are willing to hold. It changes the attractiveness of receiving in swaps. And it changes the psychology. Because traders anchor. People build comfort zones around ranges. When a range breaks, comfort evaporates. And evaporating comfort is not a feeling. It is orders in the book. Now here comes the part that separates a viewer who gets chopped up from a viewer who stays alive. This move can whip around violently even if the thesis is correct. I need you to tattoo that into your brain. The market can drop yields, bounce yields, and drop them again. It can do it while every macro argument you believe remains intact. Why? Because the market's job is not to validate your thesis. The market's job is to transfer money from impatient hands to patient hands. And the weapon it uses is volatility. Volatility is not just a byproduct. It's a tool. But that's not the part that matters. The part that matters is how you stop volatility from hijacking your decision making. Before we go there, let's make the why now calendar trigger concrete. Because timing is everything in these squeezes. Early January is often deceptively unstable. You have fresh risk budgets. You have rebalancing. You have new issuance patterns restarting after year end. You have thinner liquidity pockets as desks recalibrate. You have systematic strategies turning back on. You have portfolio managers making new year changes that they postponed in December. And you have a psychological shift. People stop caring about year-end marks and start caring about year-to-date performance. That sounds like psychology, but it becomes flow. And flow becomes price. That's where the real pressure starts. Now let's do the quick math moment, because math is what turns a few basis points into a crisis for a levered book. A 10-year bond has meaningful duration. You don't need the exact number to understand the concept. A small move in yield can translate into a meaningful move in price. If you're levered, that price move is multiplied in your equity. If your equity drawdown breaches a limit, you cut. If you cut, you move the market. If you move the market, you force the next cut. That's the chain. So when you hear someone say it's only a 10 or 20 basis point move, your response should be only for someone who isn't levered. In the real world, it's never only. It's either manageable or it's not. And manageability is dictated by leverage, liquidity, and margin, not by vibes. So what happens next? Here's the clean 2-scenario lens you need for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. In this scenario, yields bounce higher off the low, maybe toward the upper 2, 8s, or into the low 2, 9s, as the market catches its breath, as shorts regroup, as profit takers take something off, and as supply events hit the calendar. The key word is controlled. You see the bounce, but it fails to reclaim the prior comfort zone. Price doesn't give back the entire move. Liquidity returns, but not enough to reverse the regime shift. If this scenario is playing out, what you all see is the market repeatedly struggling to push yields meaningfully above that 2, 9-ish region. You'll see dips in bond prices get bought quicker. You'll see periphery spreads stay relatively contained. You'll see swap spreads and funding signals not flashing stress, more like normalization. And then, after the retest, the trend resumes. The market has converted the level. That's the process. That's the confirmation. But that's not the part that matters. The part that matters is that this scenario punishes people who chase every candle. It rewards patience. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the market doesn't give shorts time to breathe. Liquidity stays thin, options-related flows keep amplifying, and the squeeze persists. Yields push lower from around 2. 8%, maybe probing into the mid-2. 7s if the move is strong, with violent intraday swings. The signature here is urgency. You see outsized moves during odd hours. You see futures move before cash. You see sharp one-way sessions that end near the lows in yield, meaning near the highs in price. You see signs that someone is forced, big prints, sudden air pockets, and then snapbacks that fail to reverse the move. In this scenario, the risk is not that you're wrong. The risk is that you're right and still get shaken out. Because the market will weaponize volatility. It will create a scary bounce just to make you doubt, and then it will roll again. That's the squeeze movie. And it ends only when the forced buyer finishes, when the market finds new sellers, or when a counter catalyst arrives. If this one level breaks, the math changes, and people act like they've discovered fire. Now, let's get concrete with levels, because retail investors and macro watchers need handles, not poetry. Think of trigger 2, 8% as the pivot zone. Below that, the market is asserting that the repricing is real, that the squeeze is alive, that the demand for duration and collateral is still dominant. Above that, especially if yields can reclaim and hold something like the low 2. 9s, the move can cool, not reverse forever, cool. And if yields push up and can hold somewhere around the mid 2. 9s to near 3. 0%, that would be a stronger sign that supply and term premium are fighting back, that the squeeze is fading, and that the market is returning to the prior range behavior. That's a potential weakening signal. Not an automatic invalidation, but a warning that the snap might be transitioning into chop again. On the other side, if yields push into the mid-2, 7s, and the market can't bounce, then you're in continuation territory. That's the zone where shorts get more uncomfortable, where hedgers get more urgent, and where a one-day move can suddenly become a one-week move. But that's not the part that matters. The part that matters is the confirmation signals you watch while everyone else is arguing about a headline. Here's what you watch, in plain language, without needing a Bloomberg terminal fantasy. You watch whether the move is being confirmed by curve behavior. Is the long end rallying more than the front end? Is the curve flattening or bull steepening? You watch whether periphery spreads remain stable or start widening sharply. You watch whether the euro is behaving like a repricing or like a panic. You watch whether the market is reacting more to supply events than to data releases, because that tells you who is in control, fundamentals or plumbing. And you watch the tone of liquidity. Are there frequent air pockets? Are moves clustered around certain times? Are there aggressive reversals that fail? Those microstructures are the signature of forced flows. That's where the real pressure starts. Now, I'm going to address the uncomfortable counterpoints, because this is how we keep trust. First counterpoint, fiscal supply can push yields up, not down. If Germany and Europe are issuing a lot, if investors demand a higher term premium to absorb it, yields can rise. That's true. And it's why a controlled bounce scenario is plausible. Supply pressure tends to show up as auctions clearing poorly, as dealers needing bigger concessions, as curve steepening in specific segments, and as spreads and risk assets reacting. If you see repeated weak auctions and yields grinding higher while risk assets stay firm, that's a sign that the market is shifting from squeeze to supply digestion. That would weaken the immediate squeeze thesis. Second counterpoint, inflation could reaccelerate in a way that forces the market to reprice higher yields again. Services inflation, wage pressure, energy shocks, there are multiple paths. If inflation expectations tick higher and the market starts pricing more restrictive policy again, the long end can cheapen. The signal would be yields rising alongside a stronger currency response and a front end that starts repricing too. The curve behavior would look different. It would not be growth fear rally. It would be inflation fear sell-off. That would challenge the thesis. Third counterpoint, risk on sentiment can drain the bid for safe collateral. If equities rip, credit tightens, and investors re-lever into risk, the appetite for bunds can soften, allowing yields to drift higher. But here's the nuance. Even in risk on, if the move was driven by forced short covering, it doesn't unwind instantly. The market can remain sticky. So you just are watching whether risk on coincides with rising yields and widening swap spreads or changing funding signals. That's the confirmation. Fourth counterpoint, the move could be mostly technical and temporary. The squeeze ends when the forced buyer is done. If the rally is driven by a short covering event that finishes, the market can mean revert. This is why you must separate trend signal from noise. The trend signal is the ability to hold the breakout and defend it on retests. The noise is the intraday spikes that exist purely to hunt stops. If you can't tell the difference, the market will. Now, let's install the viewer psychology shield, because this is the most profitable part of the entire conversation, and almost nobody teaches it. Volatility will try to manipulate you in 3 ways. First, it will use speed. A fast move creates urgency, and urgency creates mistakes. You will feel like you must act now. That's when you overpay or sell at the worst moment. Second, it will use reversals. After a powerful move, the market will often snap back violently, not because the thesis is dead, but because liquidity returns and profit-taking hits. Those reversals are designed to create regret. Regret creates impulsive decisions. Third, it will use narratives. As the move evolves, headlines will rotate. One day it's growth scare, the next day it's policy pivot, the next day it's supply risk, the next day it's geopolitics. Narratives are not useless, but they are late. The market has already moved. The narrative is often just the brain trying to make the move feel controllable. And when you let the narrative drive your decision, you become the liquidity for someone else. So how do you protect yourself? You pre-commit to a framework before the tape gets emotional. You decide what you consider trend and what you consider noise. You decide what would confirm the thesis and what would invalidate it. You decide where you're willing to be wrong, and you size accordingly. Because if you size too large, you'll be forced to react to noise. And being forced is the entire problem we're analyzing. You don't want to become the thing you're trying to understand. But that's not the part that matters. The part that matters is staying solvent and calm while the market is trying to borrow your nervous system. Here, as a simple operational way to think about it without giving you trading advice or pretending we'll say guaranteed outcome, treat the level around 8% as the pivot. If you're watching for confirmation of continued Bund strength, you want to see yields struggling to move back above that zone on bounces, and you want to see the market responding to negative catalysts with muted sell-offs. That's stickiness. If you're watching for invalidation of the squeeze, you want to see yields reclaiming and holding higher zones. Think low 2, 9s turning into support, and eventually something closer to 3, 0% holding with confidence, along with signs that supply is being absorbed only at higher yields and that spreads are behaving differently. The market tells you through behavior, not through opinions. And now the what to watch next week checklist, without pretending we have perfect information. First, watch the auction and issuance rhythm. If the market demands meaningful concessions and yields lift into supply, that's a sign the bid is less desperate. If supply gets absorbed without drama and yields stay heavy, that's another. If supply hits and yields can't rise, that's a stronger sign the squeeze pressure is still dominant. Second, watch the curve. If the long end keeps outperforming, it suggests the market is leaning toward growth caution and term premium compression. If the front end starts moving differently, it suggests a policy repricing is happening. Third, watch periphery spreads. If they remain calm, it supports the core collateral and rates story. If they widen sharply, it suggests stress is migrating, and you need to update your regime assumptions. Fourth, watch the feel of price action. Forced flows leave fingerprints, fast moves, thin liquidity pockets, repeated failures to reverse on bounces, and occasional violent snapbacks that don't change the trend. Let's pull the camera back one more time, because this is bigger than Germany. A Bund yield, moving to around 2. 8% is part of the global story of how markets are recalibrating the price of safety, the price of inflation risk, and the price of government funding. It's a story about whether investors are demanding more term premium for holding long bonds, or whether growth worries and collateral demand are pulling yields down. It is also a story about whether the post-2022 world, where everyone learned to fear inflation, has shifted into a world where growth scares and fiscal realities trade blows. The market isn't settling that debate with a speech. It's settling it through positioning pain and spread behavior. And that brings us back to the phrase European margin call. The reason that phrase resonates is because it describes how these moves feel in real time to professionals, not like a philosophical debate, like a set of urgent tasks. Reduce risk, raise cash, hedge exposure, calm the risk manager. Don't get liquidated at the worst moment. That urgency can create outsized moves in the most liquid markets on Earth. If you have never watched a supposedly safe government bond market move like a meme stock, you haven't seen what leverage and margin can do when liquidity gets thin. It happens. It's not daily, but it happens. And when it happens, it changes how people think about the next move. The market can't unsee it. So where does that leave you? The finance-minded retail investor or macro watcher who wants logic and mechanisms, not a bedtime story. It leaves you with a simple identity. You're not here to chase the candle. You're here to track pressure points. You're here to watch the plumbing, the spreads, the calendar, and the behavior. You were here to respect two truths at once. The thesis can be right, and the tape can still hurt you, and the tape can look scary and still be noise. That's the mindset that keeps you from becoming the exit liquidity. If the Bund stays pinned around this 2, 8% region and keeps rejecting attempts to push yields back up, the market is telling you the repricing is not done. If yields bounce into the low 9s, and then roll back down, the market is telling you the breakout is being defended. If yields reclaim and hold near 3. 0% with improving auction tone and changing spread behavior, the market is telling you the squeeze energy is fading and supply is regaining control. And if you see periphery, spreads widening sharply while yields do something chaotic, that's the market warning you the regime is changing again. You don't need perfect predictions. You need a process that updates. One more thing, because it's important. Do not let anyone sell you certainty. The most dangerous voice in markets is the one that sounds calm while promising inevitability. Real professionals speak in probabilities, scenarios, and signals. They know the market can humiliate them. They plan for it, they size for it, and they survive it. The goal is not to be right on every tick. The goal is to stay aligned with the bigger pressure while letting the smaller noise pass through without stealing your decisions. So if you want the clean takeaway in one breath, it is this: the Bund at around 2. 8% is not a trivia fact. It's a stress test of positioning, collateral demand, and curve logic, arriving on a calendar that amplifies moves. Watch the pivot, watch the spreads, watch the auction rhythm. Respect the two scenarios, and don't let volatility rent space in your head for free. If you're the kind of person who wants the mechanics, the signals, and the checklist instead of the comfort story, you're already ahead of the crowd. And when the next wave hits, because it always does, you'll be watching the right things while everyone else is arguing about the wrong headline.